Every crisis follows the same script: markets panic, politicians promise action, and central banks step in as saviors, flooding the system with freshly created money to prevent collapse. The narrative is always the same. Without intervention, the economy would implode, banks would fail, and ordinary people would suffer. The central bank, we're told, sacrifices its balance sheet for the greater good, taking on risk to stabilize markets and restore confidence. It's a story of heroism, of technocratic competence saving civilization from the abyss. But if you follow the money, if you track what actually happens after the cameras stop rolling and the headlines fade, you discover something far darker. Central banks don't sacrifice during crises. They profit from them. Every panic, every crash, every moment of maximum fear becomes an opportunity to expand power, transfer wealth, and reshape the financial system in ways that benefit the institutions at the top while leaving everyone else holding the bill. This isn't conspiracy, it's structure. The mechanism is built into the system itself, hidden behind complexity and justified by necessity. And it's been happening for centuries, from the first central bank in Amsterdam to the Federal Reserve's actions during COVID. The pattern repeats because the incentives never change. When crisis strikes, those who control the money supply don't just respond to the disaster, they leverage it. And by the time the dust settles, they emerge richer, more powerful, and more essential than before. Understanding how this works requires looking past the surface, past the press releases and economic jargon, to see what central banks actually do when the world is burning. Because the real story isn't about saving the economy, it's about who gets saved first and who pays the cost of that salvation. The modern central bank was born not from benevolence but from crisis and self-interest. In 1694, England faced a problem. The country was at war with France, the treasury was empty, and the king desperately needed money to fund his military. Private creditors were reluctant to lend because the crown's credit was terrible. Previous monarchs had defaulted on debts, confiscated wealth, and generally proved unreliable borrowers. So a group of wealthy merchants proposed a deal. They would lend the government £1.2 million, an enormous sum at the time, in exchange for something unprecedented: the right to issue banknotes backed by that loan and to operate as the government's official bank. The Bank of England was born. On the surface, it seemed like a solution to a wartime emergency, but look closer and you see the real transaction. The merchants didn't just lend money, they created a permanent institution with the exclusive right to profit from government debt. The more the crown borrowed, the more the bank earned in interest. And because the bank could issue notes against those loans, it effectively created money out of thin air, lending out far more than it actually held in reserves. This was the birth of fractional reserve banking at the national level, and it established a template that would be copied around the world. The central bank's purpose wasn't to serve the public, it was to serve the government's financing needs while enriching its private shareholders. For over a century, the Bank of England remained a private institution owned by investors who reaped dividends from its operations. The pattern was obvious: wars and crises drove government borrowing, and borrowing drove profits for the bank. The Napoleonic Wars, the expansion of empire, every military adventure increased the national debt and with it, the bank's returns. By the 19th century, the Bank of England had become so essential to British finance that it could dictate terms to the government, not the other way around. It had turned crisis into leverage, emergency into permanence. The same pattern emerged across Europe and eventually in the United States, though Americans resisted the idea of a central bank for generations. The first Bank of the United States, chartered in 1791, faced fierce opposition from those who saw it as a tool for consolidating wealth and power. Thomas Jefferson despised it, calling it unconstitutional and anti-democratic. When its charter expired in 1811, it was not renewed. The Second Bank of the United States met a similar fate after President Andrew Jackson waged war against it in the 1830s, arguing that it represented the interests of Eastern elites over ordinary citizens. Jackson won, and for nearly 80 years America operated without a central bank. But crises have a way of creating opportunities for those who know how to exploit them. The Panic of 1907 was one such crisis. A failed attempt to corner the copper market triggered a wave of bank runs that threatened to collapse the entire financial system. With no central bank to provide emergency liquidity, private financier J.P. Morgan stepped in, organizing a bailout using his own fortune and rallying other wealthy bankers to stabilize key institutions. Morgan became a hero, lauded for saving the economy. But the crisis also revealed something convenient for banking interests. The system was fragile, and the lack of a central authority made panics more likely and more severe. The solution, bankers argued, was obvious. Create a central bank. In 1913, after years of lobbying and political maneuvering, the Federal Reserve System was established. Sold to the public as a way to prevent future panics and protect depositors, the Fed was actually designed by and for the banking industry. The structure was telling. It wasn't a single government institution, it was a network of regional banks, each owned by private member banks, with a board in Washington providing coordination. The profits from the Fed's operations, earned by creating money and charging interest, flowed first to those member banks before any surplus went to the Treasury. The crisis of 1907 had been turned into the justification for an institution that would, over the next century, become the most powerful financial entity in the world. And almost immediately, the Fed began using crises to expand its power. World War I required massive government spending, and the Fed facilitated it by buying government bonds and creating the money to pay for them. This was presented as patriotic duty, but it also established a precedent. The central bank would fund wars by inflating the currency. The Roaring Twenties saw the Fed experiment with manipulating interest rates to control economic growth, a practice that led directly to the stock market bubble of 1929. When that bubble burst, triggering the Great Depression, the Fed's initial response was disastrous. It allowed the money supply to contract, banks to fail, and deflation to ravage the economy. But rather than being abolished for incompetence, the Fed emerged from the Depression with even more authority. The narrative was that it needed more tools, more power, more control to prevent future disasters. The same pattern repeated in World War II. The Fed financed the war by buying government bonds, effectively printing the money to fund military spending. Inflation was controlled through price controls and rationing, but after the war, prices surged as those controls were lifted. The cost of financing the war fell on citizens through eroded purchasing power, while the banks that owned shares in the Fed collected interest on the bonds the Fed had purchased. The mechanism was elegant in its simplicity. The government spent money it didn't have. The central bank created that money and lent it at interest. The interest was paid by taxpayers, and the profits from that interest flowed, at least partially, to the private banks that made up the Federal Reserve System. This brings us to the core mechanism of how central banks turn crises into profit. It starts with understanding what central banks actually do. On paper, their mandate is usually described as maintaining price stability, full employment, or financial stability. In practice, they control the money supply, set interest rates, and act as lender of last resort to banks. When a crisis hits, central banks respond by expanding the money supply, lowering interest rates, and purchasing assets, usually government bonds, but increasingly other securities as well. This is supposed to inject liquidity into the system, prevent bank failures, and stimulate economic activity. But here's what they don't advertise. When a central bank buys government bonds, it's not spending money it has saved, it's creating new money electronically with a few keystrokes. Those bonds then sit on the central bank's balance sheet as assets, earning interest paid by the government, which means paid by taxpayers. As long as the central bank holds those bonds, it collects that interest. The Federal Reserve, for example, remits most of its profits to the U.S. Treasury, but it also maintains significant reserves, pays dividends to member banks, and funds its own operations generously. More importantly, the expansion of the balance sheet during crises gives the central bank enormous power over markets. It becomes the largest holder of government debt, the ultimate backstop, the one institution that can never be allowed to fail because the entire system depends on it. The 2008 financial crisis illustrated this mechanism at an unprecedented scale. When the housing bubble burst and toxic mortgage-backed securities began defaulting, the global financial system teetered on the edge. Banks that had gambled recklessly faced insolvency. Credit markets froze, stock markets crashed. The Federal Reserve, led by Chairman Ben Bernanke, responded with a strategy called quantitative easing, a term most people had never heard before. The Fed began buying not just government bonds, but mortgage-backed securities, the very toxic assets that had caused the crisis. It purchased trillions of dollars worth, taking them off the balance sheets of failing banks and holding them itself. The justification was preventing systemic collapse. If major banks failed, the entire economy would go down with them. Jobs would be lost, savings would vanish, and the Great Depression would look mild by comparison. So the Fed had no choice but to intervene. That was the narrative. But look at what actually happened. The banks that had caused the crisis through reckless lending and fraudulent securities got bailed out. Their bad bets were purchased by the Fed, removing the risk from their balance sheets. Meanwhile, millions of ordinary Americans lost their homes to foreclosure, saw their retirement accounts decimated, and faced unemployment. The bailout saved Wall Street, not Main Street. And here's the profit angle. The Fed purchased those mortgage-backed securities at distressed prices far below their face value. As the housing market eventually recovered, many of those securities regained value. The Fed held on to them, collecting interest payments and eventually selling some at a profit. Between 2008 and 2015, the Fed's balance sheet exploded from under $1 trillion to over $4.5 trillion. That meant trillions of dollars in assets sitting on the Fed's books, generating returns. Yes, most of those returns were remitted to the Treasury, but the power that came with holding those assets was incalculable. The Fed became the largest player in the bond market, able to influence interest rates, asset prices, and economic conditions simply by buying or selling. But the real profit wasn't just financial, it was structural. The crisis allowed the Fed to normalize policies that would have been unthinkable before 2008. Quantitative easing, once an emergency measure, became a standard tool. The Fed could now buy assets beyond just government bonds. It could intervene in markets directly, propping up prices and preventing downturns. This gave it godlike power over the economy. And who benefited most from rising asset prices? Not wage earners, not small savers, the wealthy who own stocks, real estate, and bonds. Between 2008 and 2020, as the Fed pumped trillions into the financial system, wealth inequality in the United States reached levels not seen since the Gilded Age. The top 10% of households owned 70% of the nation's wealth. The bottom 50% owned just 2%. The mechanism was simple. Low interest rates and asset purchases drove up prices for stocks and real estate. If you owned those assets, you got richer. If you didn't, you got left behind. The Fed didn't cause inequality, but its crisis response turbocharged it. And the people making decisions at the Fed came from the same institutions they were bailing out. Ben Bernanke had academic credentials, but the New York Federal Reserve, the most powerful regional bank, was run by people with deep ties to Wall Street. The revolving door between central banks and private financial institutions ensured that policy always favored the system, not the people. Then came COVID-19, and the playbook repeated with even greater intensity. When the pandemic shut down global economies in March 2020, markets crashed, governments ordered lockdowns, businesses closed, and unemployment surged. The Federal Reserve responded with the most aggressive intervention in its history. It slashed interest rates to zero, launched unlimited quantitative easing, and began purchasing not just government bonds and mortgage-backed securities, but corporate bonds, municipal bonds, and even junk-rated debt. The Fed's balance sheet doubled in a matter of months, reaching over $7 trillion and eventually surpassing $9 trillion. It had become a buyer of last resort for almost every type of asset. The justification was the same, preventing economic collapse. And to be fair, the speed and scale of the Fed's response did prevent a complete meltdown. Credit markets stabilized, businesses accessed emergency funding, and the stock market, after a brief crash, surged to record highs. But once again, the distribution of benefits was wildly unequal. Corporations used cheap borrowing to buy back their own stock, enriching shareholders and executives. Billionaires saw their fortunes skyrocket as asset prices soared. Jeff Bezos, Elon Musk, and other ultra-wealthy individuals added hundreds of billions to their net worth. Meanwhile, millions of workers lost jobs, small businesses shut down permanently, and families struggled to pay rent. The Fed's intervention saved the financial system, but it also transferred wealth upward on a massive scale. And this wasn't a bug. It was the predictable outcome of policies designed to protect asset holders. When you flood the system with money and use it to buy financial assets, prices rise. When prices rise, those who own assets benefit. The Fed knew this. Central bankers aren't stupid. They understood that quantitative easing would increase inequality. But the priority was stability for the system, not fairness for individuals. And stability for the system meant stability for banks, corporations, and financial markets, not for workers or small businesses. The profit mechanism extends beyond just the Fed's balance sheet. Consider the structure of how central bank money is distributed. When the Fed creates money, it doesn't hand it directly to citizens. It uses that money to buy assets from banks and financial institutions. Those institutions are the first recipients of the newly created currency. They can then lend it out, invest it, or use it to purchase other assets before inflation has a chance to erode its value. This is called the Cantillon effect, named after an 18th century economist who observed that those closest to the source of new money benefit most, while those furthest away, workers and savers, suffer from the inflation that follows. The central bank's crisis response always channels money through the financial system first. ensuring that banks and investors profit before the effects trickle down to the broader economy. And then there's the issue of moral hazard. Every time the central bank bails out the financial system, it sends a message: take risks, and if things go wrong, we'll save you. This encourages reckless behavior. Banks know that if they gamble on complex derivatives and win, they keep the profits. If they lose, the central bank will step in. This asymmetry creates a heads-I-win, tails-you-lose dynamic that has plagued the financial system for decades. The savings and loan crisis of the 1980s, the long-term capital management bailout in 1998, the 2008 financial crisis, and the COVID response all followed the same script. Private institutions took excessive risks, crashes occurred, and public institutions, central banks, and governments absorbed the losses. This pattern isn't unique to the United States. The European Central Bank followed a similar playbook during the Eurozone debt crisis, purchasing bonds from struggling countries like Greece, Italy, and Spain to prevent defaults and stabilize the currency. The Bank of Japan has been buying assets for decades in a futile attempt to combat deflation, now holding a balance sheet larger than the entire Japanese economy. The Bank of England, the People's Bank of China, central banks around the world all use crises to justify expanding their balance sheets and their power. And in every case, the benefits flow to financial institutions and asset holders, while the costs are distributed across society through inflation, higher taxes, and reduced public services. The genius of the system is that it's almost invisible. Most people don't understand how central banks work. They don't realize that money is being created out of nothing, that bonds are being purchased with funds that didn't exist a moment before, or that the interest on those bonds is ultimately paid by taxpayers. The complexity is camouflage. Quantitative easing sounds technical and boring, not like a massive transfer of wealth. Balance sheet expansion sounds like accounting, not like a power grab. And crisis response sounds like heroism, not exploitation, but the numbers tell the story. Since the 2008 financial crisis, central banks in developed economies have created over $25 trillion in new money. That's not a typo. $25 trillion, euros, yen, and pounds conjured into existence and used to purchase assets. That money didn't come from taxes or savings. It was simply created. And while it stabilized markets and prevented deflation, it also inflated asset prices to absurd levels, making housing unaffordable, stock valuations detached from reality, and wealth inequality the worst it's been in a century. The question everyone should ask is, who actually benefits from this system? Not the workers whose wages stagnate while the cost of living rises, not the savers whose bank accounts earn zero interest while inflation erodes their purchasing power, not the young people trying to buy homes in markets where prices have been inflated by cheap money. The beneficiaries are the owners of capital, the financial institutions, the large corporations, and the ultra-wealthy who hold the assets that central banks prop up. Every crisis becomes an opportunity for them to consolidate wealth and power, while the majority gets further behind. And here's the cruelest part. The public is told this is for their own good. We need to save the banks to save the economy. We need to support asset prices to protect pensions and retirement accounts. We need to keep interest rates low to encourage borrowing and investment. These justifications contain a kernel of truth, but they obscure the larger reality. The system is designed to protect itself, not you. And central banks, despite their nominal independence and public interest mandates, are fundamentally institutions of the financial elite. By the financial elite, for the financial elite. Consider who runs these institutions. Central bank governors and board members are drawn almost exclusively from the financial industry or from academia with deep ties to it. They speak the language of markets, not workers. They socialize with bankers, not teachers or nurses. And when they leave public service, they return to lucrative positions in the private sector, often at the very institutions they regulated or bailed out. The revolving door ensures that central bank policy aligns with financial industry interests, even when those interests conflict with the public good. The long-term consequences of turning crises into profit are becoming impossible to ignore. Wealth inequality is destabilizing democracies. Young people face a world where owning a home or retiring comfortably seems impossible. Trust in institutions is collapsing, and all the while, central banks continue to insist that their policies are necessary, that there's no alternative, that without their interventions things would be even worse. Maybe that's true. Or maybe it's just the justification for a system that has learned to profit from disaster. History offers a warning. Every empire that debased its currency, inflated its money supply, and prioritized the elite over the masses eventually collapsed. Rome fell after centuries of monetary manipulation. Weimar Germany descended into hyperinflation and fascism. The Soviet Union's centrally planned economy imploded under the weight of its own contradictions. The mechanisms differ, but the pattern is the same. When money becomes a tool for transferring wealth upward rather than facilitating productive exchange, the system becomes unsustainable. And we're watching it happen again in slow motion, justified by crisis after crisis. So what's the alternative? That's the question central bankers hate because it reveals the con they want you to believe there is no alternative, that central banking is as natural and necessary as gravity. But money existed for thousands of years before central banks. Currencies rose and fell, economies boomed and busted, but civilization didn't collapse. The idea that we need unelected technocrats with the power to create unlimited money and determine the price of credit is a modern invention, one that serves modern power structures. Alternatives exist. Decentralized currencies like Bitcoin propose eliminating central banks entirely, replacing them with algorithmic rules that no one can manipulate. Hard money advocates argue for returning to commodity-backed currencies that impose discipline on governments. Democratic reformers suggest making central banks truly accountable to elected representatives rather than operating with false independence that actually serves financial elites. Each alternative has flaws, but the point is that the current system isn't inevitable. It's a choice, and it's a choice that benefits some far more than others. Understanding how central banks turn crises into profit isn't about rejecting their role entirely. It's about seeing through the mythology, recognizing that these institutions aren't neutral guardians of economic stability, but active participants in shaping who wins and who loses. Every crisis response is a political decision disguised as technical necessity. Every bailout is a choice about whose assets to protect and whose sacrifices to demand. And every expansion of central bank power is a transfer of control from democratic institutions to unelected technocrats accountable primarily to the financial system they claim to regulate. The next crisis is coming. It always does. And when it arrives, the script will be familiar. Markets will panic, politicians will demand action, and central banks will step in with trillions in newly created money to stabilize the system. They'll buy assets, lower rates, and prevent collapse. They'll be called heroes. And once again, the wealthy will get wealthier, the powerful will get more powerful, and everyone else will be told to be grateful that things weren't worse. But maybe this time, enough people will understand what's actually happening. Maybe enough people will ask who's being saved and who's paying the cost. Maybe enough people will demand a system that serves the many, not the few. Because the pattern only continues as long as it remains invisible, as long as complexity obscures transfer, as long as crisis justifies profit. Knowledge is the first step toward resistance. Understanding how the game is played is the first step toward changing the rules. If this gave you a new perspective, hit subscribe. History doesn't repeat, but central banks do. And the next crisis has already been priced in.